Okay, it's the top of the hour, so we're going to get started. Thank you all for joining us today. We have hundreds of people from every corner of the industry on this call. Today, we're going to do a deep dive on the transferability provisions of the IRA, which have now been defined by a notice of proposed rulemaking and accompanying materials issued by Treasury on June 14th. With this guidance issued, this new multi-$100 billion market is expected to ramp quickly. I'm Alfred Johnson, the co-founder and CEO of Crux. Crux is the ecosystem of developers, tax credit buyers, banks, syndicators, and advisors to transact and manage transferable tax credits. We are the technology layer for everyone in the ecosystem to connect and transact more efficiently. Sustainable finance needs to be more efficient to facilitate and accelerate the energy transition. We're 10 people and growing quickly. Our team is composed of people with decades of experience from the government, marketplace software, structured finance, and the power industry. We have an outstanding group of panelists with me today. I am joined by Rob Parker, the Chief Commercial Officer of Crux, John Marciano, co-head of the Global Energy Practice at Allen Overy, Bryen Alperin, partner at Foss Co, where he specializes in energy tax credits, and Eric Heintz, Managing Director at M&T Bank. Eric is responsible for the bank's Renewable energy finance platform. Collectively, this group has seen every permutation of energy project finance and specifically tax equity. They have been engaged in deals already in this brand new market, and they're ideally positioned to provide insight on the guidance just released by Treasury on transferability. So today we're going to go into great detail on this big new market. I will start by providing a few summary observations before we move to discussion with the group. We've already gotten dozens of questions from the sign-up form, and we'll get to as many of them as we can. The chat is also open, so please feel free to add additional questions that come up as you're listening. Again, we've got hundreds of people on the call. We've got developers that are looking to monetize their credits, buyers who are deciding whether they should buy and what to buy, intermediaries like banks and syndicators, playing critical roles structuring these transactions. We also did get a number of questions ahead of time about the role Crux will play to help people transact more easily, especially in the wake of guidance, which is expected to increase. The need for easier transactions is expected to increase, and the need for technology is expected to increase. So Rob will close the call by talking about how the Crux platform will help you participate in this market today. As always with our webinars, we'll share a recording and summary in the coming days. So let me quickly start with the context, and then let's get into the discussion. The IRA created hundreds of billions of new credits. The credits are made more generous at the project level. They are extended for 10 years or until we get to 25% of 2022 greenhouse gas levels. They're provided for more categories of technologies and activities. And of course, the government created transferability for 11 credits to facilitate the energy transition and decarbonization. Those 11 credits can be sold to third parties for cash. Though transferability was signed into the law last August, it has taken roughly a year to get to this point. The IRA left some material aspects to be further defined by Treasury and the IRS. Last October, Treasury requested public comment on the transferability and elective pay provisions of the law. They received more than 200 comments from all corners of the industry. On January 1st of this year, it became legally permissible to sell credits, and people began to arrange deals. Some deals have closed and many more have queued on the guidance. The notice of proposed rulemaking last Wednesday provides for a 60-day comment period, which closes on August 14th and will be followed by a public hearing on August 23rd. While there are still some open questions that will likely need to be addressed by another round of industry commentary, we have a transactable market and people are going to begin to close deals. So to quickly set the table for the conversation with the panelists, I'll walk through our top 10 takeaways from the guidance. We'll touch on all of these in greater detail in the discussion. First, the guidance provided clarity on filing mechanics and timing, as well as how anticipated credits affect tax payments of credit buyers, also known as transferees. Buyers are subject to a broad concept of recapture in the case a project is taken out of service, for example, but recapture for buyers is limited in the sale of partnership interests. This is a critical point. I know the panelists are going to get into it further. The tax credits are divisible vertically, not horizontally, meaning that a proportion of the full credit can be sold, but you can't just transfer the adders. The guidance specifies the role that intermediaries can play to support transactions. Partnerships can buy and sell credits. We'll get into that in much greater depth. Cash proceeds from the sale of credits are tax exempt. Advanced purchases are permitted, though the payment must occur between the first day of the seller's tax year and the earlier of the date that the seller or buyer files its annual tax returns. The pre-registration process is detailed. John Marciano, I believe, is going to talk about that. And temporary guidance is established that gives Treasury the authority and the ability to open a portal by late 2023 to track credits. Lastly, active passive rules are expected to apply. There was some uncertainty about that in advance of the guidance, but Treasury did offer the opportunity for further comments on that issue, which we expect people in the industry to weigh in on, and the base and the bonus credits cannot be sold separately. Okay, the table is now set. Let's get into it. I'm going to start with a question for the panelists, starting with John Marciano. I just outlined 10 of the big highlights from the guidance. What do you find most notable, and which components align to your expectations? Which components were surprising? We'll go to Bryen Alperin after John.
Yeah, I think I have three main things. The vertical slicing only is expected, but it's not as limited in the statute, and so it was surprising to me that the government didn't pick something that would be easier to administer. You can really hone in on which projects or which parts of the credits you would want to audit if you can slice and dice it by markups or adders, et cetera, but they didn't prevent that. Second is you can't really do transfers in inverted leases unless you sell the project into the lessor, which no one's going to do because that sort of unwinds the purpose of an inverted lease. And then lastly, the recapture rule that puts the disposition of a partner's interest on the partner that's transferring could potentially make the interest of those partners illiquid. And so we're going to have some structuring to do to make sure that private equity aren't stuck in these deals for 5 years.
Bryen, over to you.
Yeah, thanks, Alfred. Yeah, I'll echo somewhat John said, but on the inability to sell credits, through the lessee entity was a bit of a surprise. And we had some deals already in closing, that were inverted lease structures where we had been viewing that as, a potential option to transfer a portion of credits out. So we've had to, rethink that a bit with the guidance. So a bit surprising there. The not necessarily surprising, but we've seen, I think this guidance sort of incentivizes buyers to do some level of diligence on some of these purchases. And, so the advisors and insurance markets will likely play a role there. And, then I think as he noted, the recapture piece, there's a specific slice of recapture that stays with the seller, but most is ending up with the buyer, sort of as expected.
Eric?
So I would say that the at-risk and passive activity rules I think were generally expected, but we'll see if there's any further clarification subject to the comment period here. What was interesting was to see how much text was consumed in detailing cash versus non-cash payment or consideration for the credits. I think it's crystal clear that only cash can be used for consideration. So that's interesting. I was also pleased to see, as a tax equity investor, the amount of clarity that was provided with respect to the sale of credits from a partnership. So those are some general comments from me.
Great. So John, coming back to you, do you expect buyers to start transacting? If you were advising a tax investor, what would be some of the key things that you would want them to see or have in a deal in order to move forward?
Yeah, we're already doing those deals. We've closed a number of transactions that consider at least some transfer. We've had PTC and ITC deals where the whole point of the deal was a transfer, and those deals can be pretty simple. I tend to believe that a joint venture that just sells the credits out from under it is economically better than the traditional tax equity deal. A hybrid between tax equity and transfer is probably the best option from a practical standpoint, because the tax equity can be sort of on both sides if there ever is an audit. I really think that if I'm the buyer, if I'm like a Fortune 100 company, no one is going to get involved in my audit, tell me what I can do, or my tax return process. If someone at that company agrees to do that, they're probably going to be fired. So, we're going to have a lot of partnerships on the buyer side, so that the syndicator or the tax equity can really be the person that manages that process, and you could silo the fight to just the one project that had the credits.
And John, following up on that, so the Treasury was very detailed on pre-registration. Can you give a little bit of the summary of what they are asking people to do with pre-registration and what you expect to happen with deals that are closing in this period now?
Yeah, so every deal that we've closed so far is essentially a forward commitment, because no one knew the actual process to do the transfer, and everyone was sort of assuming that it would be on the tax return of the seller. So, the pre-registration is actually not the worst thing. It's weird that it has to happen, that you have to go through this process by a certain timeline when it doesn't exist yet. But I think it's perfectly fine. It'll be workable. Just putting a number on a tax return of the seller rather than having a whole set of documents you have to attach is just more administratively easy. So I'm optimistic that we're going to have a smooth process here.
Great. So Eric, heading over to you, how do you expect banks to navigate this new market? What are some of the things that you'll be thinking about as you look to scale your business here?
Yeah, I see banks participating in a variety of different capacities, depending upon if they've been an active investor to date on a tax equity basis, that there's clearly a path there by way of the hybrid structure John was referring to. I think there's some interesting things with respect to tax exempt income that we have clarity on, and the ability to potentially be more, efficient with the monetization and depreciation benefit within the partnership. So that's certainly of interest. And I also expect banks who are currently not tax investors, whether they're just not set up for it from a scale and purview perspective, or for whatever reason, to be purchasers of credits in the marketplace. There are also strategies out there to use the discount on the credit to potentially finance a rec purchase agreement simultaneously. So there's some interesting strategies there that I think banks and also other corporates may look to follow. And then, as I mentioned before, I think there's a facilitation that banks can provide. We're certainly accustomed to doing diligence from evaluation and other tax considerations on these underlying assets, particularly when we're talking about an ITC. So there's value there that an active investor can provide, and expect to see the current set of tax investors to be active in the syndication or broader facilitation of the sale of credits.
Eric, do you know if the federally regulated and the state regulated banks can avoid having to do any funny registration or funny approval process if they're just buying rather than tax equity?
I would think, and this is not regulatory guidance in any way, shape, or form, but I would think the answer is yes. It's far simpler, because this is just a straight purchase of a credit of a financial instrument in that regard. So I would think the answer is yes. It's not an equity investment, and that's one of the considerations the banks, or one of the difficulties that banks have had historically, is making equity investments that are generally not permissible at one's bank. Although there certainly have been changes in that regard over time, and there's merchant banking authority and other things that we probably don't need to get into here. But I think the short answer is yes. I think it simplifies the regulatory consideration. I would note that as a seller, there are potential considerations for CCAR and adverse scenarios, and thinking about the ability to sell one's credits and what that does from a a regulatory capital perspective, where I think folks are still examining that as we are currently at this point in time. There'll be more to tell in that regard over the coming months.
Rob, from a market perspective, we're increasingly seeing tax equity and transferability coexist within the market. Give some of the perspectives that you've been seeing in the market of the way that those two structures might interact.
Yeah, both are going to continue to play a significant role in the industry, and sometimes honestly coexist in the same deals. I mean, the tax equity market isn't going anywhere. It provides benefits from depreciation, more established path to step up, and it will continue to be used, especially for larger, fully contracted transactions. Where we're seeing tax credit transfer transactions already are, a few key areas, especially smaller solar deals, C&I portfolios, community solar, storage, which is often not contracted. Non-investment grade off-takers are generally uncontracted assets and PTCs, spot, forward strip. We're also seeing a lot of interest, especially as it pertains to medium, larger deals for sort of hybrid approaches. And so especially from the perspective of a bank or a syndicator, there's a capital efficiency in using a tax equity partnership to step up the basis of a project and then sell the credits out of the back. And so we expect banks will do a large number of transfers like that to continue to do more deals.
Bryen, Foss is such a leader in the syndication of tax equity. Give us some perspective on how you see the syndication of tax credits evolving in this new market.
Yeah, so I think with the guidance, that's allowed for, made it clear that intermediaries are allowed to play a role here and that you're allowed to transfer to partnerships. I think it really will enable this syndication market. And I look at the state tax credit market and sort of how that has evolved, where, in the early days, Foss was brokering state credits, certificated credits, and we'd find a project, we'd go find a buyer of that credit and broker a one-off transaction. We eventually moved to a fund model where we would, set up a fund. Buyers of those credits would commit to the fund and say, hey, for the next 3 years, we'll buy as many credits as you bring us at this price, or some arrangement like that. And that really allowed that market to get very efficient. And we have, something like 35 of those active funds that just, buy as many credits as we can send them. So I think if we can, mirror something like that in the federal market, where we can make things much more efficient, as sellers are looking to market their credits, they'll know there's sort of these funds that just have standby appetite ready to buy on certain terms. And from the buyer's perspective, it also, it's sort of like the analogy I make is, you can, in your 401k account, you can do stock picking and pick specific companies, or you could, go to like a mutual fund that's going to give you more diversification and be more actively managed. So I think the buyers could, some will appreciate the diversification and sort of the simplification of that fund model.
Great. And Bryen, maybe sticking with you on the accounting treatment here, how do you expect the guidance to impact the tax and accounting treatment of these credits?
Yeah, so for existing investors in the market, a lot of them, they've gotten comfortable with the accounting, but some of them are sort of living with it, not it's reluctantly, I guess, because it can be challenging with all the HLBV analysis, et cetera. And there's a lot of potential market participants. I would say, as we speak to hundreds of companies a year about potentially participating in this market, the accounting guidance has probably been the number one reason that corporations didn't move forward in the past. So the fact that we can avoid equity method accounting and get to a much simpler accounting approach, is attractive. I mean, obviously they still need to work with their auditors and make sure that, they're getting the right, advising on the accounting side, but it appears to be, significantly simplified. And I think that'll make it much easier for some of these groups to participate. It also allows for, smaller groups to participate. If you were only going to invest a couple $1 million, sometimes it was, daunting to think about all the hoops you had to jump through just to participate in that small transaction. I think this will allow for, the combination of the fund syndication and the simplified accounting hopefully will allow, some smaller buyers to participate easily.
Yeah, and I'd add on to that. I think it is clearly a very positive attribute of the transferability mechanism for the buyer, that it should be very straightforward for the buyer or the purchaser to buy these credits and account for them. I think there's KPMG released a pretty big guide for transferability and refundability very recently. It's quite a weekend read, but certainly a place to go. But I do think it's far simpler for the purchaser. There are considerations that we're exploring right now as a seller from a tax equity partnership with respect to basis reduction. I think the guidance is helpful here in regards to the tax accounting treatment, that we have basis reduction from the member in the partnership that has been allocated credits consistent with partners' distributive share. So that's clear. What we do from a GAAP accounting perspective, that's going to take a little bit more to explore, but a consideration at this point in time.
Great, Eric, maybe sticking with you. So the guidance generally places the risk of recapture to the buyer. How do you think buyers are going to manage that risk?
So I would expect, if we're talking ITC, where there is the more traditional recapture associated with concerns with valuation, I would expect the first and foremost, the diligence, the appraisal, the cost seg, those sorts of considerations to be important. I feel that banks are certainly accustomed as tax investors at this point in time to conducting such diligence, but thereafter, indemnifications and insurance will and I think clearly are already important concepts and considerations for a purchaser. So taking an investment grade balance sheet as an indemnity is a considerably different thing than taking an indemnification from a small company. And as a result, I think you'll see very different insurance requirements between those two transfer examples.
Yeah, and that's why putting that risk on the buyers just don't. Like, Congress tried to grease the wheels of the market by permitting small projects or small developers to sell, and they thought this would decrease the need for institutional type transactions, but they screwed it up. They did not think about the fact that putting it on the buyer means the buyer's going to look for recourse to someone, and that someone doesn't have credit usually.
So let's spend a little bit more time there. Bryen, can you talk about the role of insurance that you're anticipating in these transactions?
Yeah, I mean, I think tax credit insurance, it appears that, tax credit insurance markets are ready to cover, a variety of different risks on these transactions. And I think they'll play a critical role. To buyers, I'd say it's important to work with, the right advisors and insurance brokers to make sure that you're getting the coverage, that you think you are. If it's an insurance product that's been sourced by the seller, there's incentive to go for a lower cost policy that maybe doesn't have the full coverage that the buyer actually wants. So I think we'll see a move to buyers driving the arrangement of those policies to make sure that they're getting covered and that way it can cover things like the seller giving them incorrect reps or something like that. So I think it'll play a critical role. That said, for some of the buyers out there, also don't want to just go into a transaction expecting to rely on the insurance. So they're still looking for some level of diligence and, want to be wary of the counterparties that they're transacting with. So I'd agree with John there that, it still will present, even if you put insurance on it, there will still be some transactions, I think that may be challenging to get institutional buyers to participate in.
And it's not just the diligence. I mean, they're always going to do diligence.
Yeah.
It's also the credit.
Right.
A lot of the investors that we work with, they will, if you have insurance, great, but they assume that they're looking to the guarantor, and they want the guarantor to be creditworthy, irrespective of the insurance.
Yeah, I'd agree with that. I mean, we've seen, it's as groups are sort of defining their parameters right now for what the criteria are that, for credits they're going to buy. It's pretty common that they're putting some kind of credit worthiness, whether it's investment grade ratings or et cetera, from the seller. So that's, something that's being taken into account, say, especially with the ITCs and the credits that have a recapture exposure.
I would also,
Go ahead, Eric.
sorry.
Then I'll ask
Yeah.
another question on smaller deals.
Just from kind of a sequence of mitigants, if there's a bank purchaser, I would expect the diligence to come first and foremost, then the credit quality of the guarantor, and then the insurance consideration, because a bank doesn't want to fund into an indemnity, it doesn't want to fund into insurance. Those are certainly great structural mechanisms to have. I would also note too that on the flip side, as a tax equity investor in a partnership, if I'm assuming that there's a forward commitment in place, commitment to take out a certain portion of the credits from the partnership, I'm going to be very concerned or interested in the credit quality of the purchaser, so as to ensure that I'm not stuck with an amount of credits that I'm not able to monetize. There I think will be ways to reallocate to prevent that issue from ever happening, but it's a consideration that will be far more oriented to is the credit quality of a purchaser in that example.
Eric, is that a service that you guys can offer as a tax investor to kind of bridge that for the lenders?
I'm hopeful. Not yet a product that's in place, and obviously contingent liabilities like guarantees in that regard are consideration, but it's one of the things that we're kicking around at this point in time.
Yeah, I meant also more like if you commit to be the tax investor with the idea that they'll probably be sold down, then the lenders will be comfortable with that. And
yes,
obviously you and Bryen
yes.
are great at selling, so you'll be fine.
Yeah, we've seen some of our investors that, they may have limited appetite in terms of their own tax liability, but, as a way to further participate in this market, are willing to be sort of a standby buyer of last resort, and lend their kind of investment grade rating in exchange for, some kind of commitment fee. So I think we'll see some of that evolving, especially for these, if you're talking about a long strip of PTCs, 10-year strip or something, the lenders probably want to see a strong creditworthy buyer standing behind that.
Let's dig deeper on small deals. There have been a number of questions in the chat that relate to that. So Bryen and then Rob, how are you seeing smaller deals come to market? What are some of the themes there in the early transactions that you expect to close?
Yeah, I guess I can take a stab at that. I mean, I think we, as we've entered the renewables market, our goal has always been to help drive institutional capital to some of the more underserved segments of the market, including some of these smaller deals. And I think transferability does help, but there will still be an expectation of diligence and creditworthiness. I think there will be, though a kind of risk and pricing consideration for some investors. So there are groups out there that are a little more yield driven, maybe willing to take more credit risk on the buyer in exchange for, a higher yield. So some of that might just get priced in. But for, if you're talking large banks or, Fortune 500 corporates, a lot of these groups are very risk adverse and, more focused on just making sure they've got a highly de-risked deal. So it'll be a little challenging there. I think we've also been thinking about like the residential market. If you're talking about thousands of rooftops, what's going to be the administrative burden for the pre-registration process, et cetera? And is that going to be something that when it ultimately goes to, as our buyers filing their taxes, is it going to be an administrative burden for them to verify all those? So there's, just some pieces there that I think need to get worked out, but I hopefully it will bring down transaction costs significantly, which will, help make it more economic to do some of these smaller deals.
Yeah, I think one of the stumbling blocks that Bryen has talked about for smaller deals with tax equity historically just has been sort of spreading the transaction cost over the value of a small deal. And that's an area where I think transferability is going to help a lot. We're already working on transactions that are deals on the smaller side of the spectrum. And I think you'll see community solar deals easily funded as a single transaction or as a portfolio. I think you'll see portfolios of C&I and resi deals also get funded. You know, how deals are being done, and I think the panelists talked about this in the last couple of questions, is the deals we're working on now all have insurance, recapture, basis step up, you know, certain other aspects of it, and then looking to some level of sponsor indemnification. And, you know, some will be investment grade, some won't be investment grade. And I think where that flushes out a little bit is just sort of through pricing. And I think this, just like Bryen talked about, there's a spectrum, and some deals will price higher than others. And I think that's how the market will probably in the near term adjust and reflect that.
So the little guys that have no option, Rob, you think they're like 50 cents and the big folks are 95 cents?
No, I'm not going to provide pricing comments here, but I do think you will absolutely see trades in the mid upper 90s for,
yeah, no, we're seeing those
high
already.
level of guarantees. Right, exactly. I mean, we're seeing deals in the upper 90s right now. So
I think I saw one at $1, which was really surprising.
Let's stay there
No,
for a minute. So in both your opening comments and just now, you talked about some live deals that you all are working on. Can you give us a little bit of a flavor for what those look like, the kinds of deals that are coming to market and the kinds that you think will be directly behind that?
Anything you could think of. It's is Eric speaking? So
Eric,
for me,
I think you're cutting in and out a little bit, Eric.
I can answer. So we're seeing every type of transfer you can think of. We have PTCs for existing deals that are kind of, maybe some of them are post flip. We have PTCs that are generated before the tax equity comes in a tax equity deal. We have ITCs that, well, they were supposed to be of the adders, but basically upsize type transactions where the tax equity hits their cap. And then we have both PTC and ITC deals where the transaction was started off with the expectation of either having a tax equity with a transfer or a JV with a transfer or just a transfer. And we're seeing orders for all kinds of sizes, PTCs of $500 million a year from some buyers. So, there's a lot of appetite here. And I think it's needed because, you've got some of these carbon capture transactions where you have $700-800 million a year in PTCs.
Great. John, I'm going to follow that with a question that we have from the chat. How can partnerships be transferors of credits? Talk about how that functions in the guidance.
How can a partnership be a transfer? Well, the partnership is, well, it's a little bit contra to the way that the credits work, because the way that the credits work under the tax code is each partner is treated as placing in service their share of the basis of the project. But be that as it may, a little bit of inconsistency. For this purpose, they treat the partnership as the owner of the credits, and that's the one that sells it. So each partner doesn't have the right to sell. So if you're partner A, you can cause the partnership to sell just your portion. Partner B gets the full amount that they would have gotten, but you cannot do it unless your partnership agrees to do it for you. So you have to kind of pre-negotiate that in, or just make sure you have a good relationship with your partnership, with the partnership itself. Now, a lot of times we have tiered partnerships where the partner A, in my example, is itself a partnership, and people were asking, well, can that entity make the election? The answer is no. The lowest tier and the taxpayer is the one that makes the election. So if it's a partnership, fine. If it's a corporation, fine. But where's the lowest one?
Great. So obviously this market is going to have to expand pretty dramatically from where it currently exists. We anticipate transferability to draw more people into the market. For all of you, and as Eric signs back in here, starting with Bryen, what do you think new buyers in this market are going to look like?
So, yeah, I mean, we've got, I think, a lot of groups that have maybe looked at participating in these markets in the past and for a variety of reasons didn't, and many of them are active in different tax credit markets like state credit markets. So I think those will be some of the first, to enter the market, as they're already pretty familiar with tax credit transactions in general. They've taken a close look at this in the past. So we're seeing a lot of them, take new interest. There's also, I think, one advantage of the Inflation Reduction Act in the industry is just the general awareness. The executive teams of pretty much every major corporation in the country are aware of these credits and thinking about them. And so, when we're reaching out to these groups, I think there's a lot of interest. So I see a lot of, there's already been a lot of participation from the banks and insurance companies, but I think that, the general corporates I see getting a lot more involved here. Some of the insurance companies that, in the past haven't been, I think will be getting involved. I think we'll see smaller groups like community banks or, regional corporations that maybe are only looking to buy a few million a year that previously that didn't make much sense. Now able to participate in a bigger way. So that, I think we'll see a lot of these new buyers entering the market. That said, it does take some time for, that sort of education, like going from, yes, we're very interested to actually executing a deal can be a long process for especially a large corporation. So, I think the industries, the folks on this call are going to be working hard to bring, as many of those buyers into the market as quickly as we can to kind of support all the growth that's happening on the project side.
John, anything you'd add to that?
Yeah, we're seeing a huge mix. It's some of the folks that we've been doing tax equity with for years. They've said, I want to do some transfers. I want to do some tax equity going forward. A lot of those are banks. A lot of those are insurance companies. We're seeing, grocery store chains. We're seeing office supply companies. We're seeing restaurants. Like, just it runs the whole gamut of the economy. So it's doing what Congress intended in that sense. I'm pretty happy actually that the buyers generally can't be people, because like people are problems.
Eric, anything that you would add about new participants in the market and what we think the shape of demand is going to look like here?
Yeah, and I apologize. I'm going to leave the video off here, and hopefully you all can hear me. Again, apologies for my connectivity issues, but I would look at it like a typical bell curve from an early to the majority sort of adopter to the late adopters, just across and any sort of new market. I think so long as we hopefully have good behavior in this marketplace and good performance with respect to the monetization of these benefits, I think we'll see even more corporates come in, which is essential given the sheer magnitude of the credits that are available and the need for monetization. The types of businesses that John is referring to doesn't surprise me. I think we'll see it across the board, and it'll have to come from lots of nooks and crannies to satisfy the market. That's for sure.
Great. We have a number of additional questions on insurance. So obviously having insurance is one thing, but a thing that people care a lot about is how strong that insurance is and how likely it will be to fund in the event of any issues. What can you say about that? Let's start with John there and then go over to Bryen.
We've had a number of different audits on various issues over the years on renewable tax credit insurance policies, and everything I've seen, they've paid. The brokers are limited, and they only the ones that we deal with are on pretty much every deal, and they have a really small kind of orbit of providers that they look to, and they're the quality ones. So I haven't had any payment issues. I think the only time you get a payment issue in this setting, apart from like a bankruptcy or something of an insurance company, which is super rare, would be a situation where there's just not clarity on whether the right facts were provided when they're underwriting it. So, transparency and documentation are important when you're getting insurance policy.
Bryen, anything you'd like to add to that?
Yeah, I'd say for buyers, taking a close look at what what's carved out of that policy, what could void that policy, and making sure you understand that if it's a policy that the seller, I kind of alluded to this, but if the seller is sourcing that policy and they're making certain reps to the insurance company, and if those reps end up being untrue, then that could void your policy. So you're taking some risk on their reps. It may be better to sort of have the policy that the buyer organizes and gets those kinds of things covered. Or things like, recapture due to a foreclosure for project debt, making sure that you've got that covered even if the debt wasn't in place when you got the policy. So there's some different pieces there to think through. I'm optimistic that we'll be able to get policies that do cover all those risks, but I think there could be cases of buyers, if they don't have the right advisors, not thinking through all the potential risks and not getting a policy that fully covers them. So you want to make sure that you've got all those gaps filled. In terms of, paying out, I think, I would say the same. We've generally, heard good things about, policies paying out. There are some complexities we've seen out there, not on our own deals, but, for example, if a bank is foreclosing on a project and that would cause recapture of credits, do you wait and allow that foreclosure to happen and then test the insurance, or do you try to negotiate something with the bank in the meantime and avoid the recapture altogether? So, there's still complexity there, I think, to work through, but hopefully the insurance will do a good job covering all that. And I think you should also ask questions around, how strong is that the claims department for whoever your counterparty is with the insurance group, and making sure that they're going to be a good group to work with if you did need to make a claim.
Yeah, I'm not doing a deal unless there's a inter-party where the bank agrees that they're not going to cause a recapture. I don't think I've ever seen one where that's closed. Tax equity or buyer, it doesn't really matter. The problem with the guidance is a back leverage type scenario now could cause the sponsor to be pushed out of the deal, and there might not be a tax equity investor that's there taking the transfer risk. And so the sponsor being taken out causes the recapture. Just doesn't matter who it is. In today's market, the bank just has the back leverage lender just has to say that they won't transfer their share to a tax exempt person. So it's just a ridiculous rule. And I'm going to speak at the hearing in August and give them my mind, I guess.
Eric, I saw you unmuted here. Do you want to weigh in?
I'll try. Again, apologies. Well, one thing that I think we should consider here, particularly for smaller deals that may have historically had difficulty obtaining tax equity, is the ability in a tax equity partnership. We can't have cash collateral supporting the tax equity investor, and obviously posting cash is not attractive, but it may be something that could help a purchaser in the event that you're not able to come up with the right sort of credit quality from a guarantor perspective, and it may help to augment or supplement the insurance to the extent it's required. So just throwing it out there that we've opened up other forms of collateralization because we don't have to address a
Eric, you're tailing off at the end here.
What Eric's saying is we don't have to address the tax ownership question, which is important on tax equity transactions. And so we can have a real security package like a lender would have. The seller's not going to want to do it, and the seller's lender is not going to want to allow it. So we'll have negotiations around it, but Eric's correct that you can technically do it.
Great. John, another question for you. So there's a question in the chat about if there's a ballpark default rate on tax credits, roughly what % of deals go wrong here? And that, of course, relates to the risk of recapture.
I've never seen a recapture. It doesn't happen. We've had projects burned down in forest fires, rebuilt. We've had hurricanes blow projects away. There's some technical question on whether that's a recapture event, but no one's ever actually claimed it. We've never had any other recapture like transfers of the tax exempts or anything. The only time that there's any clawback and it's not technically a recapture is when we have a fight with the government on basis. So is the basis used to calculate the credit correct? That comes up here and there. Usually the sponsor wins, but the IRS takes dumb positions sometimes. So.
Yeah, I could add to that. In other tax credit markets we've done, for example, with historic tax credits, there's surveys that were done by the industry, and it was less than 1% recapture rate. And most of those were on very small projects where they weren't following the rules right. when we looked at doing that for renewables, we worked with some of the major accounting firms. We haven't been able to find a single instance of true recapture. It could be out there, but we haven't found it. So, the survey is kind of meaningless, but yes, the eligible basis piece is important, and I think I'd also say just because it hasn't happened doesn't mean, you should ignore the risk. I think as we're with these new tax credit transfers, you still have to be, the reason it wasn't happening is because it was well mitigated, and you need to make sure that we're still mitigating those risks.
Yeah, I mean, I think the thing to keep in mind for these deals is they're all structured in a very conservative way. It's not like you're like, shooting from the hip. Everyone's trying to say there's no risk here. No one wants to get fired when it goes wrong. That's another reason why having people involved is bad. So we don't want people.
Maybe just spending another moment there, very practically, John, what does the IRA and the guidance say about the role of individuals and the application of active passive? There've been a few questions about that.
Yeah, so basically the buyer can be a person technically, but they have to have passive income to offset. They can't take the position that they're active. There's no way to group the credits you purchase with other activities. And so even if you're a member of the seller, technically you can't claim the credit if you buy it from a partnership. So it's kind of weird in that sense. You're allowed to sell to a unrelated person, and we can snake through the rules and have a partner that's in a selling partnership be the buyer technically, but they're not allowed to group it, so they have to have passive income. On the seller side, it's mostly up to the partners to figure out whether they would have been eligible for the credit to begin with, to figure out how much credits the partnership can sell, and the partnership and the partners need to really be focused on not so much passive active, but is the partner at risk under the rules? And so if the partners like claiming all the depreciation and their basis is zero in the partnership, or it's completely debt funded, they may not be at risk, which means the partnership may not have anything to sell.
Yeah, I'll just add that some of the high net worths and family offices that were participating in this market, there's often a very large consideration around the timing of cash and trying to get credits as close to their tax filing date as possible. So I think, for those types of groups, these transferable credits may be very attractive because they'll be able to potentially, time their payout, closer to their tax filing date. But I'd agree that it seems like it was, intentionally designed here to not be allowing the market to open up to a lot of new individuals, which is probably a good thing.
Great. Last general question for you guys. That the market has obviously changed quite a lot. The features of these credits are meaningfully different from tax equity. We expect many more buyers and sellers in this market. There are some specific aspects that relate to the registration of the credits, the tracking of the credits. How do you all see technology playing a role in this new market? Let's start with Bryen.
Yeah, I think there's, a number of different ways that technology will play a role. I think as we're talking about just the growth that's necessary in this market, there's going to be a need for a variety of different solutions from, helping with compliance and diligence and all of these different factors that technology may play a role in making it efficient, especially making it efficient for smaller deals. I think, in terms of the sort of transaction marketplace software, I think what's really exciting about that is, being able to more efficiently, from our perspective, take, deals out to multiple investors. So, if we did a fund in the past and we were sort of manually managing that with, let's say, 5 investors, there's a lot of work that goes into bringing all 5 of those investors along through that transaction. I think, I look at it a bit like loan syndication, where if we can have software that helps us enable, a multi-investor fund with 20 different participants, that has a lot of advantages and will, hopefully make it easier for these groups to smaller groups to participate, et cetera. And for sellers, hopefully just help lead to a more liquid market, allow them to get better pricing on their credits and, help kind of bridge the gap there between what they're looking to sell for and what buyers are looking for.
Don, Eric, anything you'd add there?
Yeah, I think we need technology. There's going to be a lot of volume here, and there's going to be a lot of special situations that will need to be kind of dumbed down to the for the government's perspective, so that they can understand what's being sold and what's being purchased. I think technology is super important. We're going to see a lot of transfers on things that haven't historically had tax equity. RNG projects, for example. Those are probably more likely to have transfers. Tax equity is not as liquid for those types of situations.
Yeah, I'd echo John and Bryen's comments. I'd like Bryen's example of a loan syndication sort of vehicle or software platform. I think it'll be very helpful in making the market more granular and more liquid and hopefully more efficient.
Great. So with that, Rob, I'm going to pass it back over to you to give some detail on how we, Crux, are seeing this market and enabling transferability. There are some live deals that are happening currently, and the platform is currently positioned to help people navigate this market. So can you give some more detail on that?
Yeah, thanks, Alfred. We obviously spend a lot of time thinking about the evolution of the transferability market. Many of you on the call are here to understand how you can use transferability. As our panelists shared, with guidance providing a lot more clarity, transaction volume is expected to increase significantly very soon. I myself have seen some of the needs for this from my experiences at Rev and Ellis Power, AES, and Google, sort of a need for an ecosystem to emerge. And so we're excited to share a bit more about the technology layer that we're building at Crux. Before going into that, though, really wanted to underline a key fact about why technology we needed in the first place. And the panelists actually just talked about some of these aspects, but there are sort of two key underlying premises or themes that were reinforced by guidance. And the first of those is total scale and the rapid scaling of the market. And the second is fragmentation. And so with respect to market size, there are a wide range of estimates, all with generally enormous mind-boggling numbers being used to size the total market for monetizing tax attributes through tax equity and the transferability markets. Given that a lot of these credits will be transferred to partnerships actually done to effectuate the step up, the actual transaction volume will be even higher. But when we think about the volume in relation to the total taxes paid, it's pretty incredible. Using CBO estimates for 2031, estimated tax attributes would absorb more than 15% of the entire US corporate tax base. And so we need so many more buyers to come to market. And technology will play a really critical role in bringing them into the industry and scaling tax financing. So with guidance out, and again, as the panelists were just talking about, as a result of allowed vertical slicing of credits, intermediaries, there will be a much more fragmented market developing for tax credits. Transferability is going to enable thousands of projects to monetize their tax capacity in a way they couldn't before. On the other side of the equation, one of the core tenets of transferability is it will bring all these more buyers into the sustainable finance sphere. And lastly, as we talked about, guidance affirmed the ability to bundle credits into portfolios as well as slice them vertically. And so taken together, the market will develop and fragment in a way that tax equity did not. And what we hear from our partners is that this fragmentation is impossible to manage that technology, to manage this complexity. And Bryen just spoke to that a second ago. And so this market, to reach its potential, will need software solutions. And Crux is that enabling layer, the ecosystem connecting everyone and managing transferable tax credits. We connect buyers, developers, syndicators, banks and intermediaries, and advisors. Crux is not a broker, but is a software platform for all market participants. So transferability is effectively a new type of asset class, a new financial product. And from discussions with hundreds of participants in the market and from transactions that we're working on now, we see the market requiring really four key pillars. The first is standards. We're working on documents to move transferable tax credits towards the equivalent of an ISDA. Liquidity. Everyone needs liquidity, which enables developers to make more informed strategic decisions earlier and at a lower cost. Risk management deals today are complex, highly bespoke, but the development of new risk management tools based on common frameworks will lower those transaction costs and bring new buyers to the market. And then lastly, transparency. Transparency, especially along with liquidity, really provides the critical price and volume signals that the market needs to enable more effective planning and capital allocation. As we discussed today, last week's guidance had a number of positive implications for our industry, as well as for driving adoption of technology platforms. And so calling attention to a few key ones here. The first is pre-registration. Software platforms will eventually be able to manage pre-registration, a large time savings for portfolios in particular. John talked about how every asset as of right now has to register, and it'll pull through registration numbers through the entire transaction workflow. Syndication without ownership. Treasury permitted syndication so long as legal ownership only transfers once. And so parties will look to software to manage transactions, build syndicates. Forward contracts. Guidance permits funding in advance of the credit, enabling forward sales and financial products. And counterparties can use software to track all of this. And then lastly, our portfolio slices that firms can track and manage portfolios as they're sliced and diced and divvied up, ensuring that information and other compliance items flow to the right parties. And so what we hear from many of our buyers is that they understand transferability and we're waiting on guidance to transact. With last week's announcement, we expect volume to increase substantially. Showing a little bit about the platform itself. First, for buyers, Crux is actively helping build towards a more efficient market with solutions for buyers, syndicators, and banks and developers. Buyers in particular are looking for a solution to help them access the full market of opportunities, understand diligence and risks, and find the best credits for them. And Crux enables that. Buyers can discover credits, explore projects further on the platform before engaging with developers they want to. After we launched, we received more than $1 billion of inbound project volume. We are ready to help buyers and intermediaries connect to new projects now. Crux is especially focused on the needs of syndicators, banks, and intermediaries who will continue to play a critical role in this capital-intensive industry. Syndicators and intermediaries want to scale their ability to connect buyers and sellers, as well as build and manage portfolios, something that becomes incredibly painful as the number of counterparties grows. And Bryen and Eric again mentioned this a few moments ago. With Crux, intermediaries can scale syndication in their own branded environment, inviting sellers and buyers into their white labeled workspace and then closing more easily. Intermediaries can also tap our growing network of buyers and sellers to complement their own and ensure they keep supply, demand, and balance for all of their customers. In addition, just want to point out, Crux, we understand the need for intermediary client data confidentiality, and we'll work with preferences of the intermediaries. For developers want a single place to connect and transact with buyers. The starting point for any transaction is finding the right counterparty. Developers can use the platform to conduct auctions, working directly with known counterparties, while also finding new buyers, intermediaries via the Crux network for large deals, to fill out the last piece of a transaction, or just to run an auction to the whole wider network. They can delegate roles to their syndicators or advisors, and from there run an entire tax credit sale workflow end to end. And for everyone, we bring the transaction workflow into a single integrated environment, simplifying and streamlining the closing process between all parties. So in summary, Crux is the enabling layer, the ecosystem connecting everyone and managing transferable tax credits. After speaking with so many folks on this call and others, we're actively building right now alongside our partners to ensure we develop the tools and solutions that the industry needs. We're incredibly glad and thankful to have you on the call, incredibly excited about what transferability means for our industry. Please reach out if you're interested in scaling syndication, buying credits, have credits to sell, or see other opportunities for partnership. And with that, I will turn it back to Alfred.
Great. We're at the top of the hour. Thank you, everybody, for joining. Special thanks to John Marciano of Allen Overy, Bryen Alperin of Foss Co, and Eric Heintz of M&T Bank. It was awesome to have you all here. As always, we will summarize and send out a recording of this, and thank you all for joining. Bye-bye.